Hey agents, Evan here with another Tactical Tuesday. Today we're going to talk on a term that's been exploded in the past year, and that's mortgage points. And are they any good for our buyers? So we're going to go over what is a point, how do I calculate a point, and then lastly, how do I evaluate if it's any good for my buyers and are they worthwhile or not? So number one, what is a point? Very simply put, it's a finance charge paid at closing to lower your interest rate. So if I pay this many dollars, I can lower my monthly payments by this much. That's all it means. Very simple. Pay my point, lowers my percentage of interest rate a certain amount. Number two, how do I calculate points? A point is 1%. 1% of what? 1 point equals 1% of the loan value. Now, there can be fractions of points and multiple points. Depending on the lender, you can go all over the place. We can go down to the thousandth of point. We have had folks buy 0.112 points. But overall, just 1 point equals 1%. If it's less than that, it's a fraction of a percent. If it's more than that, it's multiple percentage points. And it's of the loan value. So if you have a $500,000 loan, then 1 point would equal $5,000. Now, if you had someone that had a purchase price of, say, $600,000, but they were putting $100,000 down, the points wouldn't be based off that purchase price. It'd be on that $500,000 loan. So something to keep in mind is one point equals 1% of a loan value. You can have fractions and multiples as well. So then next, how do we evaluate points and know if they're any good for our buyers or not? Generally, we're very cautious with points. Industry standard will kind of say you pay 1 point, you lower your interest rate by 0.25%. In our world lately, we're seeing it, though, sometimes be more than that because we pass the point values right through to buyers. There's times where we'll see pay 1 point, bring down your interest rate by 0.5%. What does that mean? Your buyers have more breathing room or even the potential to have a little bit more capacity to go buy, which can be a big plus. But we got to figure out a way to evaluate at the time of when they're looking to lock their interest rate, are they any good or not? So we've come up with the payback period. Very common way to calculate that's out there, but here's what it is. Very simple. Take the cost of your points, divide it by the monthly savings, and you get the months to break even. Think of it this way. If you'd paid on that $500,000 loan, let's say that if you paid $5,000, you could bring down your monthly payments by $200 a month. What's the payback period? 5,000 divided by 200 is 25. Good public math is what I'm going for there, but pretty darn sure it's 25. So 25 months it takes to break even, meaning that if you don't sell or refinance your home for at least 25 months, you should come out ahead. Because once you get to 25 months, you've at least recouped that 5,000. Yes, you go time value money and some other stuff in there, but the basic level, you've got your 5,000 back. Now, month 26, 27, 28, you're truly keeping that $200 savings. So if you kept it the life of your loan, you didn't ever sell it or refinance it, you can come out way ahead. Reality is, though, especially for us working with military buyers, folks will typically tend to move to sell or refinance every 3 to 5 years or so. So we've set up, hey, when does a point really make sense? So we have our return rates. We like to say that if it's 3 years or less, really under 36 months is ideal, a point might make sense. And it depends again on the individual scenarios. But if it's under 36, it may make sense because it has a pretty high return. We've recently seen some even in the 10 to 20 payback period, meaning that if they hold the home for essentially just about a year, year and a half, and they don't sell or refinance, they could come out ahead. Those are really scenarios where a point or fractional points, whatever it is, could make sense. But if it's beyond that, it just really depends. We say there's a medium return, and it depends on the scenario heavily. If we say a low return, if it's over 60 months, meaning over 5 years for payback period. And that's where I know folks say that's a common payback period. We say, hey, common, 5-7 years. For especially our military buyers and owners, that's generally not going to make sense at all. There's a good chance they're going to sell or refinance in that time frame. So what are points? Finance charge to help lower your interest rate. How do you calculate them? It's one point equals 1% of the loan value. Multiply the whatever percentage is by the loan value. And number 3, how do I know if they're any good for my folks? Depends on their scenario, but generally you want to make sure that if you're going to do points, that you got a payback period of at least 36 months or less. And ideally you want to see it in that 15 to 25 range is the kind of the more ideal where really the wheels start turning that a point can make sense. All right, hope this helps give you some good knowledge to go out there, win more deals, and win, close, and list more for you. We're happy to help you out. Please let me know if you have any questions. Take care. Bye-bye.